Hi, my name's Ian Murray-Jones. I'm a senior tax writer with Thomson Reuters. They say that two things in life are certain, death and taxes. But I want to speak to you today about something in tax that is not at all certain. It's a proposal that may never happen, and it's not a proposal of the current government. So, what is it? It's the Labor Party proposal to restrict refunds for excess franking credits. Clearly, this depends on Labor winning the next federal election. And of course, who knows about that? But if it happens, the changes will start on 1 July 2019, in the next financial year. People really need to be on top of the measure in case Labor wins power. Now, I might make one observation before I start. For those of you who have watched either Yes Minister or Yes Prime Minister, this may have a certain resonance. In my view, the decision to propose this is very courageous. I'll explain why later. Okay, a bit of background. The dividend imputation system operates to ensure that company income is not taxed twice, once in the hands of the company and then a second time in the hands of shareholders. Let's quickly go back to basics and see what happens if we don't have an imputation system. Please note that today I'm only discussing how imputation applies to individuals. For illustration purposes, we're going to assume that the rate of company tax is a standard 30%. We'll ignore the split company rate. We'll also assume that the relevant marginal tax rate at which the dividend will be taxed is the one that currently applies to incomes above $37,000. That is 32.5%. I'm also going to ignore Medicare. As per the current slide, assume a company has taxable income of $100 on which it pays tax of $30. This leaves $70 which it distributes as a dividend. The recipient shareholder pays tax on the dividend at the marginal rate, which amounts to $23. This means that where there is no dividend imputation, total tax that is paid on $100 of company income is $53. $30 of company tax and $23 of personal tax. Let's next see what happens when there is dividend imputation. Assume the company distributes the $70 dividend as before. As the slide demonstrates, the shareholder includes the imputation credit in his or her taxable income, and the credit is applied to reduce the tax payable. In this case, the total tax paid on the $100 of income is $33 rather than $53. In both examples, the taxpayer's marginal rate of tax of 32.5% is above that of the company rate of 30%. What the Labor Party is proposing only becomes important where the marginal rate of tax is less than 30%. Currently, this is the case for those with taxable incomes of less than $37,000. We'll start by looking at the situation as it currently applies and then compare it to the outcome if the proposal is adopted. Again, the details are up on the slide. We're assuming that the taxpayer gets fully franked dividends during the year of $20,000, which carry a franking credit of $6,000, as well as interest income of $10,000. Tax on the taxable income of $36,000 is $3,382. The franking credit offsets the tax payable, and the taxpayer is entitled to a refund of the remaining franking credit not used, which results in a tax refund of $2,618. Now, this refund was not available to taxpayers when dividend imputation was first implemented back in 1987. It only became operative in 2001. What the Labor Party proposes is simply to stop refunding any excess. The taxpayer can still use the imputation credit to reduce his or her taxable income to nil. In the example, this means using the credit of $3,382 to reduce the tax payable to nil. But the balance of $2,618 will not be paid to the taxpayer. This returns the system to how it operated before the 2001 changes. Now, I've put a brief summary of the plans up on the slide. The changes will only apply to individuals and super funds. This means that they will not apply to endorsed tax-exempt charities. Similarly, they will not apply to not-for-profits with DGR status. The most obvious example of this is universities. In terms of individuals, the changes will not apply to those who are on a pension. So every recipient of an Australian government pension or allowance who has individual shareholdings will still get a refund. However, if dividend income is derived through a trust, the cash refund will not be available. Note that the exclusion for pensioners and welfare recipients extends to SMSFs. Those funds with at least one pensioner or allowance recipient before 28 March 2018 will be exempt from the changes. Care needs to be taken with this. If an SMSF member becomes eligible for a pension after this date, then it would seem that the exclusion will not apply. This grandfathering provision will mean that the exclusion for SMSFs will diminish over time, and eventually all SMSFs will be subject to the new rules. The abolition of cash refunds for excess imputation credits will cease on 1 July 2019. So there is not a lot of time for SMSFs to plan for this. The commentary in the media around the proposal has been quite politically charged, which is not unexpected. There have been two areas in particular where there's been a lot of fire and crackle. First up, by and large, the changes will only affect individuals who receive dividend income and whose top marginal tax rate is below the company tax rate. Currently, this is for people who have a taxable income of less than $37,000. But some analysts have overlooked that there can be a big difference between a low taxable income and being what I would call financially challenged. There can be lots of reasons why a person has a low taxable income. For example, there can be carry-forward losses or negative gearing. Another pertinent reason involves super benefits. No tax is payable on super from a tax source paid to people aged 60 and over, so they do not include super in their taxable income. Such people can receive, say, $80,000 in super, but only have dividends and so taxable income of, say, $20,000. The second area of contention is, will the changes amount to a tax increase? In other words, does the removal of a tax refund mean that people are paying more tax even if they're not paying any tax? Whatever you think, people no doubt will feel that something has been taken away from them. And this is why I say the proposal is courageous. One sector which will be hit by this is superannuation. Earnings by funds which are in accumulation phase are subject to tax at 15% and nil in pension phase. So super funds who derive income from dividends would be significant beneficiaries of the current refund rule. Changing it would impact the accumulation of benefits. The SMSF Association strongly opposes the proposal. I'm going to leave it here for today. I'll have to deal with super another time. But this is an area that will get more and more airplay, and it's important to keep following it. If you have any questions, contact us at Thomson Reuters ClearDocs. Thanks very much for your time.